3 down, more to go. Hey, this is Dave with the Bolduc Realty Group. Welcome to my weekly real estate market update. Today's May 5th, Cinco de Mayo. Happy Friday. Hope you guys have great plans for the weekend and for today. Before we jump into what's going on in the real estate market and the banking crisis, please like, subscribe, ring the notification bell. Comments are always appreciated. You can throw them down below there. So, key market stats today. We have 3,651 homes active on the market. We're up 85 from last week. It's a nice little bump. There were 412 new listings over the last 24 hours across the state. This was certainly better than last week. We need to see that trend continue so we can get some more inventory into the system. We had 2,943 closings in March. We're at a little under 2,600 for April right now. It does take a few days for the closings to get recorded and all that. So I'm expecting we'll be around 2,700 by the time it's all said and done. Based on March sales, we only have about 1.2 months of inventory. If we use April, it's about 1.3, so it's not a huge change. So some key dates. It was an eventful week. So the Fed met this week, and they did exactly what we expected. They increased the Fed funds rate by 1/4 point. So that's good. You always want to see what happened, what was expected to happen. First Republic Bank was taken over by regulators and later sold to JP Morgan. Now we're seeing a lot of fear around Pacific Western Bank Corp and a few other banks as well. So Silicon Valley Bank, Signature Bank, and now First Republic Bank, they were all on the list of the banks with the largest deposits that were uninsured. Deposits over the FDIC limit of $250,000 are called uninsured deposits. At a very high level, when a bank starts displaying some risks, people tend to go to that bank and try to get their deposits out of it, especially people that have in deposits that are above that insurance limit of $250,000. So this can force a bank to sell assets such as bonds to cover those withdrawals. Here's what's happening. As the Fed has increased the Fed funds rate, the yield or the interest rate on bonds has gone up. So bonds that are issued more recently, they pay a higher interest rate than bonds that were issued farther in the past. So since these new bonds pay a higher interest rate, older bonds with the lower interest rate become less valuable. If the bank is forced to sell those older, less valuable bonds, they take an unrealized loss and make it a realized loss. And if it happens too much, the bank can run out of money and not have enough money to cover the withdrawals. This is exactly what happened at SVB, at Signature, and at First Republic. So Pacific Bank Corp, among many other small and medium-sized banks, are definitely in the spotlight right now. Pacific West Bank Corp took a 40% hit in their stock yesterday. The stock rebounded this morning. We'll see how it plays out over the next few days here. So fear, it spreads very quickly. Hopefully the banking industry is able to get itself onto a firm footing quickly. The latest Fed funds rate increase is not helpful, as I described earlier, but the indication that further increases may be on hold, that's certainly a positive sign. So how does this impact the housing market? Well, continued bank failures can certainly scare buyers, and depending on how severe it becomes, what the extent of the failures are, it could push enough buyers to the sideline that demand drops below supply, which would cause prices to start to drop. I think this is unlikely, but it is certainly possible. We need to keep our eyes on it. Sellers, currently you're still in a strong selling position. There's a dramatic lack of inventory and there's still relatively strong supply or demand. Buyers, you have to stay close with your lenders. They're going to be plugged in as what's going on. Stay close with them. The best we can do is stay informed and adjust to market conditions if they change. So looking at the primary mortgage market survey, we're down to 6.39 from 6.43 last week. It ticked down, mortgage rates ticked down just a little bit. The Fed did exactly as expected, like I said, 1/4 point raise, and they gave some indications that further increases are on hold. Probably the biggest indication is what they didn't say. So in previous meetings, after the meeting, they said additional policy firming may be appropriate. That quote was not in the minutes from this past meeting in May. So that's a good sign. The stock market dipped. Rates stayed flat over the last couple days. So we have to wait and see what's happening. Who knows if that was because of the banking crisis, because of what the Fed said, probably a combination of that and a few other things. Let's hope for the best. That's what I have for today. Comments, questions, as I said, they're always welcome. Have a great weekend.